One. Good morning, Francois.
Good morning.
How are you?
I'm fine, and you?
Very good, very good. Thank you for joining me again. Torsten Slok, I apologize to you if I've destroyed the pronunciation of his name, of Apollo Management. 2 weeks ago, he announced that there may not be a soft landing, as was being expected, widely expected by the market. He said there may not even be a landing. I think that made everyone spill their cocoa. Last week, he followed up with that by saying that he didn't think the Fed was going to be reducing rates in 2024. The reasons he gave are the strength of the financial markets, basically. Obviously, stocks, but also the issuance of high yield bonds, investment grade bonds, M&A activity, and also the high level of US stocks. What are your thoughts on this now?
Clearly, he has an argument. The argument is all the elements he mentioned. If you bring them together, they bring you to the financial condition. Financial conditions are essential for the Fed. You remember what happened during 2023, especially during the consolidation of the market during July, and October. The Fed was worried about the fact that there was a tightening of financial and monetary conditions. And that was the reason why suddenly they changed course in terms of setting the message for monetary policy, telling that the time was coming to allow for rate cuts. And that brought back the market to life. And this is the reason why we have this rally. So all what he's saying at the end of the day is that financial and monetary conditions have improved significantly in the US, and there is no reason for the Fed to move too quickly and to lower interest rate. I think he has a valid argument in general that people need to have that in mind now, that it's no more the story about do we get 6, 7, 5 rate cuts, is are we going to get to the point where we get the 3 rate cuts that the market is pricing. Market realign its expectation about the Fed policy over the course of the last few weeks. Is it enough? I think that this is a right question to have in your mind. Is it enough? Is it too much? I would lean towards in the camp of those who believe that maybe even 3 rate cuts are too many for the Fed in 2024. I would not necessarily say that we are going to have no rate cut in 2024.
We're expecting non-farm payrolls at 200,000 on Friday, down from 350,000 last month. What happens if those non-farm payrolls come out as strong as before? How's the market going to react to that? Because the Fed's in a very, very difficult position then, isn't it?
I would say that, lately when you look at the market behavior, and this is something that has been striking in terms of correlation of the market over the last few months, since January at least, you had market that developed in a way where equity market were very strong, while bond market were soft and they were under pressure. You had the 10-year bond yield moving from 380 to 430. So I would say you would exactly get the same reaction. It would be positive for the equity market. It would be negative for the bond market. The main reason being that if those numbers come very high, it would mean that economic activity is not under pressure. It means that there is growth. It means that the solid numbers of earning per share growth that we get in the fourth quarter, 8%, this is much higher than what people were expecting before the earnings season, could continue in the coming quarters. So it would be supportive for the equity market. It would be damaging for the bond market, because then people would have to, again, we get back to your question, reassess the monetary loosening that we could have in the course of the next few months. So it would be a negative pressure on bond market.
Do you agree with Torsten Slok that the markets may overreact if the Fed really did follow through with rate cuts, and therefore we would go really into very, very high territories for equities and low yields for bonds, etc.?
I think that if the market overreacts, the danger is that you get to the point where you have some kind of bubble materializing in the market. And I think it would be dangerous, and this is exactly not what the Fed would like to produce. The Fed is aware that equity markets are high. You can defend the idea that they are high but not over expensive, but nevertheless, to continue and go through with, not to continue, to change course, lower interest rates too early, not only could be damaging for the real economic activity, but it could also support and favor an equity bubble. And I don't think that's what the Fed has in mind, and they will be very aware of that. If you remember, we spoke many times about the evolution of monetary policy in the US in the course of the last few months. I have always been very skeptical about the fact that they would lower that much and that many times. I always considered that the economic condition did not justify such a move, 6 moves or 7 moves. I still reckon that there is room for a cut in interest rates, but the room is getting smaller and smaller, and people need to realize that.
So what does that do to the commercial real estate market in the US and all around the world? I saw you on a Swiss national television a few days ago talking about the commercial real estate distressed debt and the issues being faced by regional banks. New York Community Bank went down by 20% on Friday, I think it was. Wasn't
Yes.
related to, I don't think it was related this time to overexposure to distressed debt. However, most of the regional banks were down on Friday in sympathy, I think.
Mm-hmm.
What's the effect of an extended high level of interest rates this year on the commercial real estate market?
This is the thing that the sector would not like to see. The higher the interest rate stay, the more trouble you could have for the commercial real estate. So this is something that is a danger, and that's something also that the Fed needs to take into account, because it's not only the fact that you have distressed debt in this sector, it's also the fact that in the coming 18 months, you have a lot of this debt or loans that need to be renegotiated, that need to be extended. So there is something for the Fed to act on interest rates in order to reduce the pressure on this sector in particular. That is one of the elephant in the room that people are looking at, because we all know that there is a problem in the US in particular, but also in Canada and some other countries. So the effect could be damaging. That's what you can say in general. It could be damaging if they do not lower interest rates.
You mentioned during the course of that interview, you talked about the level of the problem and therefore the scale of the distressed debt. I think you mentioned a figure about 200 or 300 billion, which in fact I think the Treasury spoke about those kind of numbers several months back. When you see some properties being sold 50% of valuations of just 5 years ago, how do they come to such? It's a huge figure, but to my mind, doesn't seem very high when you have so many properties breaking their covenant and going down in such a large amount in value.
The number is the number of the loans that are distressed. It's not what does it mean? It means that you have an evidence of around 200 to 300 that is distressed. And by the way, this is about 10 times more distressed bond than the next sector facing distress condition, which in this case is technology, which is about 38 billion. So what does it tell you? You have a stress, but then again, we go back to your question before. What if the Fed does not lower interest rates? Could it put some pressure on the commercial real estate? Yes, because before distress, you have loans that are able not to be distressed right now, but maybe could become distressed in the coming 6 months if there is no interest rate cut in the US and they need to refinance at such level. So that's the threat. It's not so much the 200, 300 billion. It's what is next. What is next? How much money is under threat to become distressed if there is still high interest rates in the US. And it's only in the course of the next few months that we will know exactly what is the size of this danger.
So presumably the market is going to be watching non-farm payrolls like a hawk this Friday. This can be extremely important. Although previous estimates for non-farm have been underestimating the number of job creations by quite a huge amount, actually. Do you have any personal opinion on how this is going to look this month?
You know, it's always difficult to make the non-farm payrolls in February because usually there is something that happens in January. The statistic is very often subject to an erratic number. So you need to be aware of that. So I would not make any bet. I just want to observe the numbers. I want to observe also the number concerning the average early earnings, because at the end of the day, you will also have this week some numbers concerning productivity. And I think that what is key during this week is, okay, look at the number for the non-farm payrolls, but also look at what is happening in terms of average early earnings, the salary in a way, the amount of money people are gaining, and look that towards the productivity numbers that are going to publish this week. Because this is key. If you have solid productivity growth in the US, then it's okay. You can have higher average early earnings, because at the end of the day, it means that the unit labor cost is under control. So that's the key that you want to see. And I would like to see the numbers to remain decent and to show a deceleration in non-farm payrolls, because then it would be a positive to my scenario concerning the evolution of interest rates in the US in the medium term.
Are you expecting these various points that we've discussed to have a small effect on the stock market and to calm down people's ardor in terms of buying stocks?
You have, those numbers at the end of the day, when you look at the main elements, the main factors that are in the market for this week, you have some economic statistic that I mentioned, but clearly you have Powell testimony on Thursday. You have non-farm payroll on Friday. In Europe, you have the ECB coming with the monetary policy meeting and its decision. I think those three elements, which are late in the week, are going to make the market hesitant about taking big position before those factors, which will be key for the market. So there is all the reason to have the market to consolidate at the beginning of the week, to stay calm and to move towards those numbers Thursday and Friday.
Is there anything I haven't asked you that you'd wanted to be asked?
There is the Chinese issue, because this is something that we tend to forget, but I think that this week is an important week in China. You have the National People Congress that is going to be underway. We all know that usually this is where you have significant numbers coming, like what is the target for growth, what is the kind of monetary or fiscal policy that they are going to follow. You have usually hints about that, and it's very important. So this is something I will look also very carefully, knowing that the Chinese situation, as we discussed many times already, is a situation that people need to have in mind, considering that there are structural problems in China that needs to be solved. So this is something I would take a very important look during this week.
Thank you very much, Francois. Thank you for joining us, and see you next week. Bye-bye.
You're welcome. Bye-bye.